Hi all, and welcome to this presentation with Tethys Oil. My name is Stian Vibstad, and I'm an equity analyst at ABG. And with us today, we have CEO of Tethys Oil, Magnus Nordin, which will be presenting the company to us. Magnus, please go ahead.
Thank you very much, Stian, and thank you very much for this opportunity to talk to you yet again about Tethys. So let's go straight for the presentation. So next slide, please. Tethys Oil. Well, we are an upstream company. We have finances in order, and the business model is pretty simple. We are trying to supply energy to the world as long as oil is an important part of the energy mix the world needs. We do this through the exploration for new resources, the appraisal of known resources, and production of developed assets. Next slide. For the last 10 years, we have been focused on the Sultanate of Oman. We are debt-free. We've been dividend paying since 2015, and currently we produce around 10,500 barrels of oil per day, and we have a very active exploration appraisal program in 5 separate blocks covering almost 50,000 square kilometers onshore Oman. We like to stay onshore. Next slide, please. Oman, located on the tip of the Arabian Peninsula, bordering Saudi Arabia, the United Arab Emirates, and Yemen by land, and by sea, Gulf of Arabia, Iran in the north, and if we continue further to the east, we'll find India. We've been in country since 2006. Production from our 30% interest in blocks 3 and 4 since 2010. License expires in 2040. And then we have 3 exploration licenses. Block 49, where we have 100%, evaluating results for the first exploration period. Block 56, appraising results now in the second exploration period. And Block 58, starting out with seismic. We can continue. All our production in Oman comes from blocks 3 and 4. We saw before pandemic, we were having around 13,000 barrels of oil per day. We have been lower since, hovering between 10 and 11 during the pandemic, and are hoping to come back, have guided for 10.5 to 11 for 2022. Investments are up, and we would expect to see some result from that also in our producing assets in 3 and 4. Continue. But this gives a very robust cash flow and strong financials. In first quarter of 2022, we had revenue of $34 million, giving us an EBITDA of $20 million, a net result of $9.9 million, and ending the quarter with cash in the bank of $54 million. And the achieved oil price for the first quarter amounted to $80 per barrel sold. And as you can see from this slide, we have continually seen our revenue and our EBITDA and all the other numbers increase over the year, primarily driven by the increase in oil price. And of course, for the second quarter 2022, we expect oil prices closer to $100 per barrel. Continue. Compared to 2021, when we had combined revenue of $150 million, we are already, of course, driven by the oil price, but also by a sufficiently sustained production at quite high numbers. Our price is lagging, our sales price is lagging world market by 2 months. So the May price we will realize on our July sales, and the price we will realize on our May sales is where the market was in March. So we are currently in an uptrend for the year so far. Let's continue. As I mentioned, we've been paying dividends and distributed cash to shareholders since 2015. For the current year, the AGM last week approved distribution of 7 crowns per share. A dividend of 2 crowns per share went on record on last Thursday, will be paid out tomorrow. And a share distribution through the redemption share has been approved of 5 crowns per share, and that is pending. If we look at the next slide. The record date is June 2nd to participate in this share split. Then the redemption shares will trade for about 2 weeks between June 3rd and June 17. And on June, trading will cease. So there is an opportunity of either selling the shares or letting the redemption shares go to forced redemption settlement on June 27. And to participate in this distribution of 5 crowns per share, you have to own the shares by June 2nd. Let's continue. So, key to the game we are playing and to all we are doing really is cash and cash generation. We have strong operating cash flow of $20 million for the first quarter. We invested close to $25 million in development wells, but also in appraisal and exploration assets, which ended the year at $55 million worth of cash. And the key to our strength and our success so far has been to, while maintaining financial discipline, continue distribution to shareholders over time, also in a measured way, spending on investments to maintain production, but also to increase reserves and ultimately production. So if we look at the next slide, we have been able to grow our reserves continually as we have produced. And on average, we have been replacing more than what we have produced. Underinvestment during the pandemic led to only replacing 83% of our produced reserves in 2022. We have to rectify that by increased production in increased investment this year. But throughout the years from 2010 and onwards, we still see a very positive trend also in the total resource base. And we actually increased our total resources of reserves and 2P and 2C resources from 40.8 to 41.8 million barrels. And that despite having lower investments during the pandemic period. And all these reserves and resources are attributable to our producing blocks 3 and 4. But we're now starting to see growth potential also in our other assets in Oman. So if we continue, we have a varied portfolio covering 50,000 square kilometers. It's actually almost 20% of the entire landmass onshore Oman. 3 and 4, it's producing assets. It has been production since 2010. 56 is our most exciting and most active exploration appraisal block. 49, we're evaluating a well that found oil, but that we've not been able to produce to surface in 2021. And 58, we are starting out with a seismic program. Let's do some look at some details here. If I could have the next slide. Block 56, to the south of blocks 3 and 4. Old seismic data suggests a number of potential oil fields still on the lead stage in the central area, where we have just conducted a modern 2,000 square kilometer large 3D high resolution seismic study to upgrade a dozen leads that we have to drillable prospects. A highly prospective area that is complemented by what we call the Al-Jumd area to the north. This is adjacent to the producing KSF field, right on the other side of the orange line in block 6. And our appraisal efforts are geared at the Al-Jumd area. If I could have the next slide. We drilled 3 wells in the first quarter. Al Jumd 2 horizontal appraisal well into the Al Jumd discovery, which flowed 700 barrels of oil per day on test from a 400-meter horizontal section. The Sahab exploration well, where we encountered oil in three separate reservoir sections, will be tested later in the quarter. And the Sahab 3 appraisal well, where we drilled 1,200 meters, confirmed oil shows and added oil shows in a new layer that was previously unknown, also to be tested later this year. Al Jumd holds some 12 smallish but potentially quite prolific structures that are, shall we say, an extension of the play in Block 6. Al Jumd so far confirms our expectations. We will put Al Jumd 2 on a long-term production test starting early third quarter. And depending on the test results of Sahab 3 and Sahab 1, we'll see how far we can take the Al Jumd area in the course of in the second half of this year. If we continue. Just a close-up of Al Jumd. It's sort of a chestnut-shaped structure at around 1,800 meters depth, discovered in 2008, retested in 2019. Flowed oil at both times, reasonably small quantities, 80 to 100 barrels of oil per day. We tried a horizontal section this quarter. They came in very, very well. And total measured depth of 2,032 meters yielded 430 meters of reservoir that produced at 700 barrels of oil per day initial rate. Quite a substantial increase from the vertical well drilled in 2019. We're preparing to drill 2 more appraisal wells starting early third quarter, while the structure will also be appraised on a long-term production test. So far, a very encouraging results, both for this particular Al Jumd structure, but also for the entire Al Jumd area. We continue. 10 years ago, we designated blocks 3 and 4 as a smorgasbord of opportunities. Since then, 3 and 4 has produced more than 100 million barrels and is still producing more than 10,000 barrels of oil per day with a continued exploration upside. We see strong similarities to Block 56, and we do hope that 56 will turn out to be our second blocks 3 and 4 in Oman. Continue. Blocks 3 and 4, this rather complicated slide, shows our 7 producing fields in the green shade. Seismic is being carried out in the blue around the producing areas, but also with an increasing number of leads showing up from the new seismic. Active ongoing exploration. We still see exploration and growth potential in 3 and 4, and that's which well is now complemented by Block 56. Continue. Turn to 58. We move to the west of Oman. This is all defined on 2D seismic, a number of interesting leads. The Fahad lead up in the corner here has similarities with producing fields immediately to the right of the orange line. And the South Lahan, we see a complex of potential leads that need additional 3D seismic. We've just completed a study there, and we're moving on to interpret that and hope to do exploration drilling here later this year. Continue. Thameen 1 was drilled last year in our third exploration block, Block 49. We encountered a 40-meter hydrocarbon-bearing column, so far unable to bring anything to surface. A number of studies has been carried out, and we have until June this year to decide how to move on with the evaluation of Thameen and Block 49. Next slide, please. This concludes really the survey of what we are doing in Oman. We are underpinned by the 10,000 barrels of oil production from 3 and 4 with strong upside. As you can see from this slide of all the license areas in Oman, Tethys's blue licenses are second only to Shell Oman, Sultanate of Oman joint venture PDO in green. And we are colleagues with a number of the world's largest oil companies in Oman, which has turned out to be quite a prolific area also for growth, after having stagnated in production through most of the early 2000s. To sum up, on the next slide, the Tethys investment case, stable production in excess of 10,000 barrels of oil per day. We are guiding for between 10.5 and 11 for the year. Been dividend paying since 2015, 5 crowns in redemption share, record date 2nd June this year. Cash flow funds all our exploration and distribution to shareholders. Debt-free with a big cash cushion. Strong free cash flow and strong cash flow from operations. Good reserve base, a very active appraisal exploration program, and an exciting testing program in Block 56 in progress. So both for the near term and the long term, we do consider Tethys to be an interesting investment, provided you like oil and gas. And on the next slide, I briefly want to touch on what has always been at the core for Tethys. We're a Swedish company, and sustainability, corporate social responsibility has always been high on the agenda. With increasing opportunity to talk about this, and also in the investment community expecting us to talk more about it, we are producing a more and more comprehensive sustainability report. And just a few highlights here, that we are on an environmental path where we're very conscious of what we are doing. And in particular, in our own operated blocks, we have every opportunity of making any development or any operation with green tinted outlook. And looking at health, safety, and environment, as these numbers also show, it's been at the core of what we've been doing, and we are now talking more and more about what we have always been doing. So leaving sustainability and turning to the second question for investors in oil and gas, oil price. So we could have the next slide. Just comment very quickly on where we are on oil price and what we think is going to happen. I mean, oil price is very much a function of supply and demand as everything else. We saw oil prices drop precipitously after the financial crisis in 2008 and then come back very quickly. Drop again when there was a price war, I should say a supply war between American frackers and Saudi Arabia in 2014. As that abated, prices came back a bit. And then we had another price war that was aggravated by the sharp drop in demand just as the pandemic set in. If we could have the next slide. We're seeing now that demand is ramping up very, very, very quickly. And as the world returns to normal levels, we are seeing demand actually surpassing the pre-pandemic level in 2022. This, of course, is of strong importance for price prediction in the near term. Turn to the next slide. But there are some long-term trends that have been ongoing for almost 10 years now. And I think these are more important than the short-term fluctuations that we are seeing. Next slide. First, consumption demand. We have seen continual increase in demand from the 80s and from early 2000s. We've seen an increase by about 2% a year, with a few hiccups in the curve associated with the financial crisis of 08, 09, and also, of course, the pandemic. But the trend is unmistakably there, and we are seeing demand increase, and on average, we've seen between 2 and 3% since the year 2000. If we turn to the next slide. known oil and oil fields deplete. And on average, we are seeing depletion of 5 to 9% every year from fields that are currently in production. So investments into new wells, infill wells, additional development wells in known fields, but also exploration to find new resources is needed just to meet the current demand, let alone any increase in demand. If we turn to the next slide, we see that underinvestment has been ongoing since 2014, when we had the first major drop in prices after the price war between Saudi Arabia and American shale producers. From levels close to $600 million a year, $1 billion a year into the upstream sector, we have been hovering. We have not even reached 400 the last couple of years, exacerbated even further during the pandemic. So we have an increase in demand, we have depleting fields, and we have depleting investment. The long-term trend is certainly for higher prices to lure investment back into the oil sector so that we can maintain what seems to be the demand that will be there for the foreseeable future. Turning to the next slide. Renewables are an absolute necessity. The oil industry will not be able to supply a demand or to meet a demand growth of 2 to 3% every year. But bearing in mind that in 2019, still just over 10% came from renewable sources, the rest was fossil, and this includes nuclear and hydroelectric power. So we have a very, very big gap to close to meet existing replacement to a more renewable area, not to mention any continued increase in demand. That said, I say the long-term production trend for oil price is certainly on a strong price note going forward. Turning very quickly to the next slide. This is exacerbated by short-term influences. And next slide. We are seeing the current Russia-Ukraine war affecting Russian export dramatically. And some 5 million barrels of oil from Russia has been more or less disappeared from the market. Next slide. Oil production in the United States is growing slower than expected. Despite increasing oil prices, we are now seeing a fiscal discipline unseen before in US shale producers, where cash flow distribution to shareholders is held higher in esteem than before, when drilling and increasing production was the mantra of the day. With that trend now still firmly in place, US production is not ramping up, and in no sense that it will ramp up in a way that would be detrimental to prices going forward. Next slide. You look at this one, it's rather dramatic, showing the depletion of drilled but uncompleted shale wells in the United States. And it's the sharpest drop we have seen since and the lowest number we've seen since 2013. Illustrates very strongly that the American shale companies maintain a completely different philosophy to fiscal discipline that we've seen for the last 10 years. Next slide. Inventory levels that were building during the pandemic are drawing down at a rapid pace. And the OECD, they're actually lower now than they've been for the last 20 years. And another slide. Long term, the trend is for underinvestment while demand is stable or increasing. Short term, a number of shortages on the supply side while demand is ramping up rapidly. Well, this is the oil price development from 88 to 22. We reached a high of $128 per barrel so far in 2021. I would say the short-term risk is definitely on the upside, and on the long term, we would expect average prices to be in the higher end of what we've seen historically than the lower end. On that note, thank you very much for listening, and questions, please.
Thank you for the presentation, Magnus. I have a quick question. As you talked about, you reported some very encouraging results from the Block 56 appraisal well in your Q1 report, an asset that could be a play opener for the block and also diversify production beyond the Block 3 and 4. Can you talk a little bit into what the road towards commerciality for the block looks like? And also, if we assume that the asset is commercial, what would the development look like in terms of infrastructure needs, for example?
Certainly. Okay, if we start at, as I mentioned, there are two areas really within Block 56. The assumed area is the one furthest along in bringing it on to commercial production. Depending on the results of the long-term production test and also of the additional horizontal exploration drilling, we should later in the year be able to establish a resource base, hopefully based on those results. And depending on where we come in there, we may know how close we are to actually establishing a long-term production profile and outlook for Adjunct. If the wells, the Sarha and Sahab well test well over the next couple of months, that would give an added boost to the entire assumed area. And hopefully we could see within, maybe before the end of the year, we should be in a position to be much more clearer on the potential and also the near-term potential of getting production out of the assumed area, Block 56. We are quite close to infrastructure in Block 6, and most likely an early production system would truck oil to offload facilities in Block 6. We talk 10, 20 kilometers only. So it's a rather simple operation. For the central part, we are looking at potentially much more prospective volume. As I mentioned, we have some 12 leads identified on Vinch's 2D seismic. We have concluded seismic study and processing and interpretation will take probably 5-6 months. And by the end of this year, we should be in a position both to come up with a drilling program for next year and with some ideas of how many prospective or drillable prospects we've actually been able to mature from that area. So with the let's say Adjunct could be a fast track to first early production, long-term production testing, but also to more long-term production in 56. And the central area could hopefully unlock potentials that may be, as I mentioned, similar to what we've seen in Blocks 3 and 4. But that's yet to be determined. But we do consider it to be a new smorgasbord of opportunity.
Great, thanks. Lots to look forward for the next couple of quarters. And I think actually maybe a quick last question. Your balance sheet also looks very strong now with a net cash position of 51 million, as you mentioned. You are of course paying dividends, but are you looking at any other opportunities to allocate the cash, M&A for example?
We are certainly, absolutely. I mean, we are evaluating opportunities all the time. We prefer to stay onshore. We know onshore environment. If something goes wrong, if you need to rectify something, it's a lot easier to do on the onshore patch. And when we look at other opportunities, we have to bear in mind that we have good fiscal terms in Oman. We know Oman quite well, and we have a lot on our plate in Oman. Yep. So anything else we look at has to stand up to offer has to stand up in competition to what we're doing in Oman. So certainly we could look at a country entry somewhere else at maybe a lower investment threshold. But given the position we have and the opportunities we have, it's not easy to find something that stand up to those criteria that we have to meet. But we are looking.
Makes sense. Yes, I think we have reached the end of this session. So thank you very much, Magnus, for the presentation and Q&A today. And thank you to all who listened in. Have a good day.
Thank you.
Thank you.